Kevin, you've considered a new theory for portfolio management. Should we be reassessing our attitude towards risk?
This is one of those areas where the tools available determine the job that gets done. And academic economists have had a great mathematical toolkit at their disposal. And that's encouraged them to think, because there is some logic as to why this could be the case, that's encouraged them to think that there might be a trade-off between risk and return. They tend to think modern portfolio theory is predicated on the idea that if you take more risk, you'll probably get a higher return. The danger is when we take that seeming sensible assumption, we translate it through mathematics into optimal portfolios, and we think we've got the whole thing sorted out. And the reality is that it may look as if you're paid for taking risk, but it's not the risk that results in the return, it's the assets themselves. If we were sure of being paid for taking risk, then it wouldn't be risk. And one of the dangerous things we've done for our clients as an industry collectively is we've encouraged them to think automatically that taking risk must pay off. That's not necessarily the case. Going forwards, that doesn't mean that I don't find stocks attractive. I do, but I find them attractive because I think the companies that we're investing in are pretty well run. They'll be profitable. They're not expensive. It's not the fact that they're risky that makes me want to own them. And so I'm suggesting in the book that perhaps it's time to move beyond this idea of modern portfolio theory. It's a little bit tongue-in-cheek, but when you focus on the failings of conventional theory in other contexts, when you focus on context itself, it's often appropriate to use the label postmodern. So I'm suggesting maybe it's time for a postmodern portfolio theory, which will be a little bit less sophisticated and a little bit more straightforward and hopefully safer than conventional modern portfolio theory.